Recording in progress. Good morning, good afternoon. I hope you had a great spring break. This starting from today, we're gonna study chapter 10 and the next chapter 11. After 2 weeks, we're gonna have the second test. Okay, so the test is gonna be on Wednesday. I think it's March 31st. So let me share the screen. Can you see my shared screen, please?
Yes.
Okay, thanks. So chapter 9, which is the week we before the break, we talk about option. We basically talk about option types, option positions, and option payoff profits, right? So this this chapter we're gonna talk about more information about the option. So we're gonna talk about practice. So the the topics we're gonna cover in this chapter include for example, factors affecting option price, and then we're gonna talk about assumptions and notation. Also, the very important issue, which is for this chapter, two issues is wide up and the lower bounds for option price. So for this topic, we're gonna talk about arbitrage opportunity. Arbitrage opportunity, like we talk about the before when we talk about forward and future, we also talk about arbitrage opportunity, right? So here option we still have arbitrage opportunities. And the last one, we're going to talk about protocol parity and use protocol parity to make arbitrage opportunities. Okay. First, factors affecting option price. So there are 6 facts affecting the price of a stock option. Before class, I hope you read the book so you understand the background information, not just based on the slides in class. Okay, for example, these factors in the book, they explain the very details, but we don't have time to discuss each like in details, right? So please read the book, okay, before class. For example, current stock price will affect the price of stock option, and the strike price, time to maturity, volatility, risk interest rates, risk-free interest rate, and the dividends. So to summarize that, this is notation. So we learned that, right? We know that small c, this is a European call option. C, which is the call option price. P is the put option price. If C is capital, it's American call, but we focus on the European call, okay? But the American call would be more complicated. S0 means stock price today. ST means stock price at expiration day. K is the strike price, and the T is life of option. And D is the present value of dividends, and sigma is the volatility of stock price, and R is the risk-free rates. Okay, so next, option price. Option price can be estimated using the binomial tree or Black-Scholes formula model. These are topics we're gonna cover in chapters 12 and 13. So that's material we're gonna cover after we did the second exam. But in this chapter, we talk about option price, but we just talk about the range, which is what is minimum value and the maximum value for option price. We will not calculate option price in exactly number to get exactly number, right? So here I would like you to understand, okay? The effects of the variables to affect the option price. Here is the table to summarize that. For example, C. Small c, which is European call, right? European call, European put, and American call, American put. We will not cover this. So we focus on this part. When stock price S S0 means stock price, the underlying stock price today would be positively affect the call price and negatively affected the put price. And so first you need to understand positive and then plus and negative, what that means, and how we can get that relationship. Actually, we can get that relationship by put-call parity. Although put-call parity we're gonna learn later, but actually you learn that from other class, right? So C plus K, which is the risk-free investment, and the K is the investment, and P plus stock price. So from this relationship, this is called a put-call parity. Later on, we're going to talk about that, how we get this. But assume you know this, then the relationship between C and P and S0 we can get here, right? So to be able to get the factors affect the call price, we're gonna just leave C on the left hand side and all other put on the right hand side. So P plus S0 minus K, do the discount, continuous discount. Okay, so C is call price, right? When stock price, if we hold all others variables constant, when stock price increase, C increase, right? So that's why it's positive relationship. And what about P? P, also from this formula, we can get another, which is the leave P on one side and all other the other sides. We can get P equal K minus S0, right? So because we need to move stock price to the left-hand side, so minus S0. So stock price, underlying stock price, when they go up, P go down, right? So that's why it's negative. So the book will show you detail which the relationship, why is positive, why is negative. I just give example here. Give one more example, K, strike price. For call price, when strike price K, when K increase, because here's negative, right? So negatively correlated to call price. That's why negative. And K with the P, you see K, the in front of K, this is positive. So K increase, P increase. So that's why positive. Okay, but the T is not, is uncertain, could be positive, could be negative. Okay, so you can see other relationship from the book. Okay, we don't have time to cover everything here, but see example 1. When the strike price K increase with all else remaining the same, which of the following is true? Both call puts increase in value, both call put decrease in value, call increase in value, while put decrease in value, put increase in value, while call decrease in value. Which one? I just talked about that, right? I just talked about.
Professor?
Yeah.
The calls would increase while the puts decrease if the stock price increases.
Yeah.
Oh,
so
if the strike price increases, it would be the opposite. The calls would decrease and the puts would increase.
Answer is what?
D.
D. You can see that K, right? We talk about K. K increase because this is negative, so call will decrease. When K increase, because this is positive, so when increase, will increase. So answer put increase and call decrease. Yes, answer is D. Good. So if you don't know what's that, you just write down the make arrangement for the put call parity. Put call parity, this formula is in the formula sheet, right? So if you have the formula sheet, just do some adjustment and you will see the relationship, right? So that's easy, but you need to know how to figure it out, right? If you don't know what's that, you probably cannot know. It's hard to memorize, right? It's hard to memorize. You don't need to memorize that. Okay. If I change the strike price to For example, I change strike price to dividend. The present value of dividends increase. What would be the case? Dividend increase, the call price will decrease and the put price will increase. So answer is the call decrease, put increase. So same thing, right? Same thing as the K. So you see K and the D basically same thing. And the stock price and the the risk-free rate, the same case, right? And this is the standard deviation of the risk, which is volatility of the price. That would be the difference. Okay. So that's example I showed you about the factors affecting the option price. Next, we're going to talk about the option price. We're going to talk about lower bound and upper bound. Lower bound and upper bound, which is the talk about the minimum value and the maximum value. Before we talk about that, here are assumptions. We assume that there are some market participants, such as large investment banks, for which the following statements are true. First, there are no transaction costs. So we are talking about theory, right? But in reality, it must be a lot of transaction cost. Second, all trading profits are subject to the same tax rates. Third, borrowing and lending are possible at the risk-free interest rates. Okay, so which is all talk about theory. We assume that these market participants are prepared to take advantage of arbitrage opportunity as they arise. So we're going to talk about arbitrage opportunity. First, up and lower bounds for call option price. So first we talk about call. No matter what happened, the European call option can never be worth more than the stock price. So which means the maximum, the up bounds, or say the maximum value for the option price would be stock price. Okay, so the upper bound and the lower bound for the call option price would be, this is the upper bound, and this is the lower bound. So lower bound, you can see how to calculate that. They're calculated by maximum value between stock price minus K to the discount and then 0. So this value now cannot be negative value, right? The minimum would be 0, but it's hard to be 0 because the call, if you buy an option, you must pay something, right? It cannot be 0. Okay, but this formula, this function, just to make sure you are not pay negative value, right? Because the depend on the stock price and the K. Okay, so here talk about the range, lower bound and upper bound. Arbitrage opportunity, which is the in theory, the price must be within this up and the lower bound must within this range. If the market, I'm talking about the market option price within this range, there is no arbitrage opportunity. But if the option market price below, which is below the lower bound or up or higher than the upper bound, then there is arbitrage opportunity. Okay, so if option price is above the upper bound or below the lower bound, they are profitable opportunity for arbitragers. Arbitrager could make a riskless profit by if it's called, this is always true, you're gonna buy the option. Actually, we talk about this case. This case, which is the market option price lower than the lower bounds. So we're gonna buy low, sell high, right? Buy low, we're gonna buy low and sell high. Okay, so buy low, which is buy option contract from the market, and sell high, which is sell the stock and invest the proceeds of the sales at the risk-free rates. Okay, So why this is buy the option? Because the market option price lower. So we buy low, sell high. Okay. So that's the strategy. Similar to what we discussed before, right? We always, when we talk about arbitrage opportunity, we always do buy low, sell high. So let's see example two. Example two, a European call option on a non-dividend paying stock with the strike price 18. So strike price K 18. Expiration day in 1 year, and the cost $3. So this is called, this is the market call price. This is market call price. The stock price is 20, and the risk-free rate is 10%. What are the up and the lower bounds for the option price? Is there an arbitrage opportunity? If yes, what are the action now and action in a year? What is net gain? Okay, so that's we have 1, 2, 3, 4. We have 4 questions. First, we do up and the lower bounds. We now see the upper bound is the stock price today, and the lower bound is maximum value between S, between stock price minus the discount and the 0, right? So we know the stock price is what? Stock price 20, strike price 18, and the risk-free rate is 10%. And what is a T? T is 1 year, right? So time 1, and compare with 0. And the stock price is 20. Okay, so here give you the lower bound and the upper bound. Can you calculate that? Anybody get the lower bound?
The lower bound is $3.71.
3.71, yes. So this is the, basically it's called the estimate the option, which is lower bound, okay, lower bound. Okay, so we did the question 1. What are the upper bound and the lower bound? Upper bound $20, lower bound $3.71. Okay, so that's question 1. Question 2, is there an arbitrage opportunity? Because option, the market option price $3. $3 less than $3.75, right? So to answer question 2, yes, because $3 less than $3.71, right? Because the market option price lower than the estimated lower bounds. Okay, if it's yes, then what's action? The action today, action now, we're gonna buy low, sell high, right? So buy low, which is buy the option for, you need to pay the price $3, right? You need to pay $3 for the option price, which is market price, and the short the stock to get $20, right? You sell the stock, and you can invest because you get $20 by selling the stock, and you need to pay the option $3. So how much you can invest? How much usually?
$17.
Yes. Okay, make sure you understand why 17, because the money you receive 20, the money you pay 3, so the money left 17, okay, for 1 year. So that's action now. Then action in 1 year, in a year. Action in a year depends on, so this is the harder part. Depends on, I'm gonna move to here. For option, when we talk about arbitrage opportunity, we always need to consider the stock price at the expiration day greater than strike price or lower than strike price, because they're the option, right? Because that's option. If stock price greater than the strike price is what, 18, right? So let's talk about the first case. If the stock price higher than the strike price, then what are you gonna do? First, you're gonna exercise, because you buy the option, which means later on you're gonna buy, right? And the expiration date, the stock price higher than the strike price, so you should buy lower, right? So you can exercise the option. Exercise option to buy stock for the strike price 18, right? And once you buy the stock and use the stock to close out the short position, right? Because you take short position at the beginning to close out short position. And you do investment, so you're gonna receive how much? $17. That's your principal, and you do continuous compounding. So 0.1, 10% interest rate, and for 1 year. So you can find out what's the investment income. And the net gain, which is the money you receive and the money you pay. What's the money you receive from the investment? Anybody get the investment income? How much?
It's $18.78, Professor.
Yes, that's correct. Good, thanks. So 18.79. So the money you receive is 18.79. The money you pay is $18 to buy the stock. So the difference is 0.78. That's your net gain if the stock price higher, okay? So I said that could be the other case, right? So what about if stock price lower? If it's lower, you will not exercise the option, right? You can go market to buy the stock at the lower price, right? So buy stock for ST, because ST lower than 18, so you don't need to exercise option, right? Option 18, that's too high. So, and then you're gonna close out, use the stock, same thing to close out short position. And also you receive investment income, $18.79, right? And your net gain, in this case, the money you receive is 18.79, and the money you pay, we don't know what is ST, but we know ST less than 18. So this is for sure is greater than 0. But just to put ST there, okay? Because the ST less than 18. So the net gain is positive number. Okay, so what is net gain? We answer the question 3 and 4 together. So that's how we solve the problem like this. Please do similar work, okay, in your assignment. Any question on this? Question? So you see action in a year, you need to differentiate 2 cases, which is the stock price at the expiration day higher than the strike price or lower than the strike price. That because this information very important because it's you're gonna decide to exercise or not, right? The option contract. Question? No question?
No questions, Professor.
Okay, good. So I just show you the slides in my sign. So this is basically solution. I would like you to see you're gonna do similar, okay? So for example, up lower bound, you need to list what is upper bound, what is lower bound, and then do the calculation, okay? And then compare the current option price $3 with the lower bound because lower, so you have a arbitrage opportunity. And then for the actions, you have action now, you're gonna buy the call because lower market price and short the stock and you invest $17. So you need to know how to get 17, which is money you receive minus the money you pay. Okay. And the action in 1 year. So if the stock price greater, right, you need to see, you need to differentiate the case for stock price and the strike price. So if stock price higher than the strike price, you should exercise the call option, right? Because you buy the stock, you can buy lower, which is the strike price, and use the stock to close out short position. And you investor, so you receive investment income. So if you figured out the wrong number for principal, then you will not be able to get the right answer for investment income, right? So this is very important. The net gain, which is the money you receive and the money you pay, and the difference, which is your gain. And the other case, if stock price less than strike price, so you can buy the stock from the market, right? Rather than the option, exercise the option. So you use the stock to close out short position, receive income, and the net gain is 18.79 minus ST. So ST, we don't know what is ST, but we know ST less than 18. ST less than 18, so 18.78 minus ST, this is greater than 0. Okay, that's we know for sure. Question? So like I said, we just talk about the case when the market price lower than lower bound. Actually, there's another case, which is the when option market price higher than the upper bound, right? But we didn't cover that. So it's, I think as long as you know one side, the other side would be similar. So we focus on the one side for which is the market option price lower than the lower bound. We talk about the call. Now we talk about put. Up and lower bounds for put option price. The European put option at the maturity cannot be worse than K. So we are talking about the maturity less than K. So the up bound for put price would be, because when we talk about price, which is at the time 0, right? And here talk about T, K is at the expiration date T. So the upper bound for puts, we should discount K to the time 0. That's why here, this is upper bound, okay? We do discount K back to time 0, so continuous discounting. So the up and the lower bound to the put option price, the upper bound is the present value of strike price, but the lower bound similar to call, right? The difference is what? Now we do K minus S0. Why? Because for the put option investor expect the stock price will going down, right? In that case, you're gonna make money. Okay, again, the lower bound must greater than or equal to 0, right? Cannot be negative value. So first, this is the upper bound and the lower bound for put option. Again, similar to the call, we have a arbitrage opportunity question. So here is the lower bound and the upper bound. Within this range, if the option market put price within this range, there is no arbitrage opportunity. But if lower than lower bound or higher than upper bound, there is the arbitrage opportunity. Okay, similar. Okay, similar. If option price is above the upper bound or below the lower bound, they are profitable arbitrage opportunity for arbitrager. Arbitrager could make a riskless profit by buying the option. Again, we talk about this case when the market put price lower than the lower bound. We just talk about this case. So market put price lower than the lower bound. So we're gonna buy low, sell high. So we're gonna buy the option, but here why is buy? Because this is a put option. Because this is a put option. So in the future, you're gonna sell it, right? So you're gonna buy stock today. In the future, you're gonna sell it. Okay. So buy the stock. So how to buy it? We're gonna borrow money to buy it. Okay. So sell, which is sell in the future, because that's option. This is the put option. If you sell a put, which means in the future you're gonna the buy stock today. In the future you're gonna sell it, right? Because put option. You buy stock today. Okay, so let's see example 3. European put option on a non-dividend paying stock with the strike price of 40. Okay, K is 40. Expiration date 6 months, cost $1. So this is market put price. Put price. The stock price 37. The risk-free rate 5%. What are the up and the lower bounds? Is there arbitrage opportunity? If yes, what are actions? And actions in 6 months, what is the net gain in 6 months? Okay, similar to example 2. Let's do lower bound and up bound first. Maximum value between K, do discount, minus stock price compared to 0. That's lower bound. And the up bound is K, do discount, right? Do continuous discount. So that's formula. And then we just plug the number to the formula. K is 40. Interest rate 5%, 6 months. So 6/12. Minus stock price. Stock price is 37 compared to 0. And the upper bound is 40 which is the first component when you do calculate the lower bound, right? Can you do the calculation? Tell me what's the upper bound and lower bound.
The lower bound is 201 and the upper bound is 3901.
Yeah. So the 2.01, that's correct. And the higher bound is 39.01. Good. So first find the lower bound and the upper bound. And then ask you, is there arbitrage opportunity? Yes. Yes. Because the market price, option price is $1 lower than 2.01, which is lower bound, right? And then what would be actions? Action now, we're gonna buy low, buy the put option, right? Buy put option for $1. That's the price, which is market option price, $1. And you should buy the stock because in the future you're gonna sell it. So buy the stock for $37. So you have to buy. So which is you need to borrow money to buy all this too. So borrow how much? How much?
$38.
Yes, 38, right? So because you need to buy put option, you need to buy the stock. So total is $38 for 6 months. Okay, then we're gonna talk about the actions in 6 months. If stock price greater than the strike price 40. So if it's the, let's talk about the less than case first, because this is put. When the stock price lower, you basically will exercise the option, right? So when stock price lower than 40, you should exercise put to sell stock because you purchased at the beginning, so you can sell stock for $40, right? And you need to repay the loan. That's money you're gonna pay. The money you pay, the principal is, we know the principal you borrowed $38. So it's $38 due continuous compounding 0.05 for 6 months. How much you're gonna pay? That's repay the loan.
$38.96.
38.96, 38.96, good. So the net gain is the money you receive, which is $40 from the selling, and the money you pay, 38.96, that's the loan cost. So the difference is
The gain is $1.04.
yes, that's correct. $1.04. Okay, so here talk about stock price lower case for because the when stock price lower, the put option you might highly likely to exercise that, right? And also we're gonna talk about the other case when stock price higher. That's possible, right? So we need to discuss that case as well. Stock price higher than the 40. So if it's equal, student may ask me, if it's equal doesn't matter, right? You can exercise it or you can buy from the market because equal. So anyway, so if it's greater or equal. In this case, you should what? Sell the stock to the market because you can get a higher price, right? You sell the stock for ST because ST greater than 40. And again, can you finish that? So I'm gonna let you do some exercise. So can you finish that and tell me what would be your net gain? I'll give you 2 minutes and I'm gonna ask a student to complete that for me. So you're gonna have action 2, action 3, right? Action 3, which is the net gain. Ken, Rutanic, are you
Yes.
there? Can you complete that for me?
Is it for the second one is repay the loan for 38.96?
That's correct. Pay the loan for 38.96, which is same as the first case. And then your net gain would be
Negative because ST is greater than 40.
no, because you sell the stock, that's money you receive, right? ST minus, right?
40.
We don't know what is ST, but we know ST greater than 40, right? So ST minus 38.96. So this should be greater than 0, right? But yes, you are right. So ST minus 38.96. Right? That's not a negative, right? So although the case 2, we didn't know what's exactly number, but for sure we know that's positive value, okay? And the case 1, we know exactly number because we exercise put, we pay the, we sell the stock to receive $40, okay? So you can see example 2, example 3, very similar, but one we talk about the call option, the other is put option. Again, we just talk about one case, which is the when the option price, when P less than a lower bound. And the other case, which is the P greater than the upper bound. We didn't cover, but that would be similar. Okay, if you are interested in that, you can try it and let me know if you have a question. Okay. So to summarize what we talk about today, we talk about the factors affecting the option price, and we talk about assumption, notation, and then we talk about upper bound and the lower bounds for call and put option price. And the most important thing you need to know is how to do the arbitrage opportunity if you know the market option price. Okay. So in reality, you might be able to use what we learned to do some option investment, right? So to first figure out what's the estimate, what's the lower bound and upper bound, and then compare to the market option price. Okay, that's what we've discovered today. So we're gonna have all material finished by Wednesday. So any question? But you can start to work on the assignment, okay? Any question?
No questions, Professor. Have a great day.
Yeah, you too. Thank you.
Thank you.
Yeah, see you Wednesday. Bye.